Welcome back to Fast Money. It was another record day on Wall Street with the Nasdaq closing at a new all-time high. Our next guest sees more records ahead as we head into the new year. JPMorgan's Marko Kolanovic is Wall Street's biggest bull. He's got a 4,400 price target on the S&P 500 for the end of next year. Marko joins us now on the Fast Line. Marko, it's always great to speak with you.
Thank you, Melissa.
Today, we clearly saw leadership in tech, but you don't expect that to be the leadership group going into next year. And you see next year being marked by a few V's. Can you explain?
Yeah, so we basically expect vaccines, that will be the first V, to drive economic growth, especially in the second half. And we think that's actually going to cause value and cyclicals to outperform. So basically, that's our view. And we also see that in an environment of declining volatility. So those will be kind of three V's: vaccines, value, and declining VIX, or declining volatility.
We were just having a Fed discussion, and you make clear in the notes that I've read, Marko, that you don't think that what happened with the Fed today was really anything impactful when it comes to the markets or your market call. But at the same time, should we start to worry in the context of what you are forecasting for the markets, 4,400, which is very bullish, should we start to worry about the economy actually snapping back so quickly that it shows signs of heating up, inflation spikes up, and that the Fed actually starts to think about taking the punch bowl away?
So no, I'm not worried about that for the following reasons. So first, I think it's going to take a little while for the population to get vaccinated and for the economy to fully reopen. So we see that really in the second half. Secondly, Fed said they are not planning to raise rates until 2023. And they indicated they would be willing to tolerate inflation overshoot. Keep in mind, for the last decade, we had inflation undershooting 2%. So I think they can be patient. And again, we see that more as a sort of second half, the economic recovery story. But we think that market will sort of anticipate that and move ahead.
Hey, Marko, it's Tim. Thanks for joining
Marko,
us.
it's Brian Kelly.
Is the dollar? Oh, go ahead, Brian.
So Marko, it's Brian Kelly. Sorry, I'm just curious. As we see this increase, Fed's probably going to look for inflation around 4% ish or so. They've said that. Does that impact your forecast at all?
So no, not initially. We think that sort of the uptick in inflation expectations will give a boost to value and cyclicals that will lead the market. And they will still keep the rate at zero, the near-term rate, and they are still purchasing actually fixed income securities, so keeping the lid also to some extent on the back end of the curve. So we think that we will see some steepening that should help the value in cyclicals. It doesn't necessarily help the growth and momentum stocks like technology, secular growth stocks, but we think there's going to be some very broad index inflows into equities as investors reallocate from bond to equity, so that's going to keep sort of also that growth and momentum segment afloat. So we don't see, at least for the next year, inflation to be negative for the equities.
Tim, you have a question?
Marko, we played a game yesterday with making up our acronyms, and I chose one that was RISE, which basically was cyclicals as it relates to commodities and emerging markets. What's your call on those into next year?
So I like both. I like both of those. I often find, Tim, me and you agree. So basically, weaker dollar, stronger growth, a steeper yield curve, a recovery from coronavirus. We think all of that helps value, and all of that helps emerging markets. Emerging markets are exposed to inflation expectations. They're exposed to commodities, and we see sort of as the economy heats up in the second half of the year, that basically gives a lift to emerging markets. Emerging markets, if you look at the broad index, it's still below its 2007 peak in dollar terms. So we think actually there could be some more meaningful reallocation towards emerging markets and also value cyclical stocks. So this is sort of part of the same trade.
Given where valuations are right now, Marko, and given the groups you see leading the market next year, is tech a short going into 2021?
So, because we have this quite optimistic S&P price target that cannot be achieved unless tech also go up. So I would say, I wouldn't say you should short that. These are still companies that are, innovating, generating decent revenues. So I wouldn't necessarily say shorting, but I do believe that value, if you look at the sectors like energy, like materials, industrials, financials as well, I think they're going to sort of lead. They're going to outperform. So it depends. If you're a long-short investor, market neutral, you may. But overall, if you're long-only investors, we think actually this tide will lift all boats.
All right. Marko, always great to speak with you. Thank you.
Thank you so much.
Yeah, happy holidays. Marko Kolanovic, JP Morgan. Guy, what do you make of Marko's call?
Well, it's interesting, and I'm just going to read. So Jerome Powell was asked about, asset prices today, and he said PEs are high, but risk-free rates will remain low for an extended time, so PEs don't matter. Or not relevant. So which is, fantastic, I guess. So, any price target makes sense when the chairman of the Federal Reserve makes a comment like that. I think he's probably spot on. I don't think we go there in a straight line, and I'll stand by that. I think he's probably going to wind up being right. But I think, we don't get there from here, and I think there's a real good chance we revisit this sort of 3,400 level at some point early next year in the S&P 500.
So evaluations don't matter because interest rates are so low. I'll go back to Tim because you're the big resource trade proponent. Does it matter? Why not just stick with technology? Why not just stick where the growth is?
So, right, because if one of the V's is value, who cares? And that connects with me as Guy brings this up. But I think that the dynamic of reacceleration of global PMIs, and again, where we bottomed, and the fact that Marko pointed out some of the drivers that always work in emerging markets. They include a weaker dollar, they include lower interest rates, but they include a reacceleration. And actually, we do want to see some asset price reflation, inflation. So to me, I think that is still an important trade. And Guy's highlighting something that should be troubling. But I also think that valuations overall are kind of, people are getting that mulligan on 2021 for sure, and looking to 2022. But the technicals, the trends, and I think the drivers for the resource trade are make them outperform.
Dan?
Yeah, so if we're talking about mulligans, we're talking about PEs not mattering, then I'll just give you 3 charts that are fantastic, 2 of which have been my final trades over the last 2 weeks or so. It's Apple, it's Microsoft, and it's Amazon. These things have been consolidating massive year-to-date gains, okay, but consolidating over the last few months. They're still below the all-time highs made a couple months ago, and they look like they want to explode. So if you're bullish and you think the market keeps grinding higher, and you also think that resource trade or some of these stocks hardest hit, whether it be in transports or in some of these other spaces by the pandemic, have gone too far too fast, and we're going to have, I think, what BK calls a re-rotation, then get back in the F-MAGA trade, because that thing looks like it's about to leave the station.
Shepard Smith here. Thanks for watching CNBC on YouTube.